Everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, as the virus turns the housing market. Hope you're doing well. Today is the 12th of May. It's a Tuesday. My name is Randy Patrick. I'm your host today, putting the realism back in real estate just for you. Hope everyone's doing well. Once again, I've got a ton of information to go through today. So much happening out there. It is tough to keep up. We'll get into it in a second now. Let me just set up a few things with my nice little setup here. Okay, off we go. We're good here. And we are definitely going to bring in my shared screen look so we can follow along, which is great. All right, let's take a look here. Can I make it even bigger? I don't know. There we go. All right. We're all set. So again, today's May the 12th. It's a Tuesday. Lots going on in housing. So the real information is about, I guess you could say, jobs. That's where things are looking. That's where things are headed. That's causing all the problems right now. So again, Housing Bubble 2.0, that's me. That's my contact information up there if you're looking to get a hold of me. And I know people have actually called me just before I recorded this, so I will definitely get back to people today after I'm done here, which is kind of cool. So let's take a look at this next little slide. So let me get all set up here. Again, I'm still kind of getting used to all this, testing out other software as well too. So here we go. All right, let me get a chance here. Beautiful. Okay. And by the way, if you're not already a subscriber to my channel, please help my channel grow and subscribe. I'd really appreciate that. Why? Because I'm giving you the realism and the news you want to hear in real estate. There you go. Okay. So number one, the first real issue is unemployment. Basically, a lot of, I guess you could say, articles are saying, yes, we may have, 14 or 15% unemployment rate right now, but there's really a whole bunch that's not being counted. And our job report is actually way worse off than is indicated in the local news media and what's being captured right now. So very, very, we had a resulting in a 14.7% unemployment rate in April. And basically people are saying, nope, it's actually a lot more. When you take a look at, let me move down this one here too. When you take a look, and that's from the New York Times, by the way, that I guess that image shows this big drop off on the right. It goes to it's the entire length of the, I guess you could say, front page of the New York Times. Just kind of interesting here. Well, what they're basically saying is that when you have all these, people that are employed but not as work for other reasons, unemployment, part-time, when you're adding all sorts of things here, they basically say the total is effectively 42 million unemployed, which puts us at about 25.5%, I guess you could say, unemployment rate. You've got your headline rate, which is called U3. You've got your underemployment U6, and this, the 25% is your effective rate when you have disengaged workers, people that have got reduced hours, part-time jobs, stuff like that. So, it really boils down to, I'm not an economist here, so you can go and take a look at all this, till the cows come home. But ultimately, in the end, what we see is some statistics which are poor and bad, but what's going on is actually a lot worse behind the scenes. That's the point I'm trying to make here. That's the point of these articles. And by the way, these articles can be found in the information section of the video. If you want to look and link to them, all the info is right there. Okay, so basically, of course, what happens when we have unemployment? Unemployment drives forbearances, and essentially that request number is up again. So the number of mortgages in the coronavirus-related forbearance rose by 37 basis points between April 27th and May 3rd. So last week, as the unemployment rate kept growing, according to the Mortgage Bankers Association. So we got a little about 4.1 million forbearance requests at around May 3rd. That's about 7.91% of all outstanding loans in forbearance, compared to 7.54% the week before. And of course, this is from the National Mortgage News. The source is MBA, National Mortgage, or National Mortgage Bankers Association. And we take a look at the stats here. You can see that the total were almost 8% in forbearance. Non-depositories have been growing every week. Obviously, depositories, institutions have been growing quite a bit. And, we're talking about some big numbers here. So, for example, you've got Ginnie Mae, for example, FHA, Veterans Affairs, U.S. Department of Agriculture and Housing Service Products, basically rose from 10.45% to 10.96%. So that segment is getting really hit hard with the forbearance requests. Basically, what else am I looking at here? FHA is, Fannie and Freddie are up here, but we're at, we're basically taking a look at almost 9% now. Or sorry, 7 and a bit here, almost 8%. So 7.9% of all mortgages right now are in forbearance. And again, that was for the week ending, I guess you say May the 3rd. Now, don't forget, what I want to point out, though, is that May the 1st was a Friday, so Saturday, Sunday. So I can tell you that, if people didn't pay on the 1st, or they didn't request forbearance on the 1st, on Saturday or Sunday, we can see this week being an increased week for forbearance requests, because this will be a full week entering now. Actually, probably the week before, we'll see a full week of from essentially the 4th to to 10th or whatever it is, 4th to the 12th, 9th. That'll be a full week of new forbearance requests coming in on a second month now. So we'll see how that actually goes. And again, mortgage bailouts, what they say here, mortgage bailouts swells to 4.1 million borrowers, but demand is slowing. So thought is, well, every week we've seen less and less and less, which is great. But again, as I mentioned, we're now in the first full week to report on with May, and we can see where those numbers are going to head. Probably by the end of this week. I think Thursday or Friday we'll find out those numbers. So again, the number of forbearances represents $890 billion of unpaid principal, includes 6.4% of all Fannie and Freddie backed loans, and almost 11% of all FHA VA loans. So a lot going on here. We're almost 8% of all mortgages right now, they're in forbearance. Okay, there you go. So of course, what happens when we have this is that eventually the forbearance numbers do get counted in the mortgage delinquency rate. So basically what we're looking at here is the mortgage delinquency rate jumps with forbearance tallied, because even though from a logical or physical perspective, you may have put your mortgage payments off, you have paused them. From a delinquency perspective, it still counts them as it's a late payment as far as they're concerned. Even though you didn't pay it, you may be going to some specific plan with your lender, it's still late as far as the I guess you could say the statistics are concerned here. So basically, the share of home loans overdue by 30 days or more rose to 4.36% of all mortgages, up 59 basis points from an all-time low in the fourth quarter. NBA said in Tuesday report, Mortgage Bankers Association once again. Again, they're just saying NBA survey asked servicers to report these loans as delinquent if the payment was not made based on the original terms of the mortgage, in the same manner that delinquency data is collected during natural disasters. So, and that's been a comment to a lot of the forbearance. Is in play for natural disasters. So they're actually kind of treating this virus, the COVID-related things, like a natural disaster with respect to the mortgage industry. So that's how it's kind of being handled and reported internally with banks, lenders, and servicers. All right. More information here. More Americans are expected to miss mortgage payments. So Center for Microeconomic Data released in the April 2020 survey of consumer expectations shows considerable deterioration in households' expectations about most economic outcomes, including household debt. So really, the perceived probability of losing one's job reached a new series high for the second consecutive month. So basically what they're saying here is that more people, as time goes on, expect to be missing their mortgage payments. Whether they're going to jump into forbearance or not, we don't know yet, but the expectation is that you're going to see a lot more people who are going to say, you know what, our household income is decreasing and we're having problems. So we're going to see this increase. And again, that's difficulty for people out there. So we're going to see the effect of that. All right. Now, struggling homeowners, difficulty making mortgage payments. So this is really a lot of the news now. We see the forbearance numbers, unemployment numbers. The net effect is people trying to make payments, they can't do it. Basically, Apartment List found that 31% of Americans made either a partial house payment or no payment at all in May, an increase from the prior month. 22% of homeowners made no housing payments in May. Also, those who work remotely have had an easier time paying for housing, with a May delinquency rate of 10 percentage points lower than those going to the office. The report found that 69% of renters and homeowners paid a full housing payment in May, which is considerably lower than April's payment of 76%. So there you go. So again, everything is struggling. Lower income households are struggling the most, clearly, as 71% of homeowners making under $75,000 a year do not pay their housing bill. So really, it's just a lot of, again, bad numbers here. More and more people are struggling. it's going to lead to problems in the next few months and down the road for sure. All right, now this is interesting, and this is what I I thought was pertinent for the situation. So we have a portion of the we'll call it media, analysts, economists, real estate industry who of course are saying, hey, we're not going to see very much decrease in home values, maybe 3 or 4%, due to the virus. Things are good. We've got all these government and lending plans in there to help homeowners. We're going to be great. Well, for me, that just rings like the last housing crisis. And again, as I mentioned, I'm not basing what I think is going to happen on the last housing crisis solely. But when I see stuff like this, I can relate and go, you know what? This is how problems will manifest down the road. So some homeowners are getting mortgage bailouts by mistake, and it's keeping them from refinancing. So in a rush to help consumers who have been impacted financially by the coronavirus pandemic, the government authorized a massive mortgage bailout called the CARES Act. Some borrowers' inquiries were misunderstood, and some servicers, swamped with hundreds of thousands of calls, just put the borrowers in the program. Okay, so whether you liked it or not, you wanted it or not, you were in the program. Since early March, complaints to the Consumer Financial Protection Bureau, CFPB, have soared, with mortgage complaints leading the charge. Funny how that actually works, right? So basically, listen, 4 million people saying I can't pay my mortgage, throw me into forbearance, is quite a we'll call it onslaught of call center activity, web activity, whatever you're going to say, for these lenders to handle. So we have to give them a break on that. I realize that, but basically what's happened is some people just were automatically put in the forbearance, not asking for it, and when they've gone to refi their loans, their refis have been denied because when credits reports are pulled or the application process is going on for a refi, the new lender is going, wait a second, you're in forbearance. I'm not going to refi because you're in forbearance now. So now what has to happen? You have to call your lender going, take me out of the forbearance, blah, blah, blah. So it's a pain in the butt. You know what I mean? And, this will cause problems. It's one of those things where you're supposed to make your payment, but you can't because you're in forbearance. You want to get refi, but you can't because you can't get out of forbearance because the lender's not responding to you, hasn't taken you out yet. So we're going to see some of these problems, and it's just the nature of, just the lender's operation, volume, things falling through the cracks. This is why it was things like this that were rampant in the last housing crisis, where people try to do loan modifications, try to do save programs and other government programs for their home, that they fell through the cracks, lost their homes to foreclosure because they just weren't being serviced or couldn't be serviced or wouldn't be serviced because of the issues at the lender's offices, in their operations. So, it's just basically, this will cause more problems and more pain for homeowners. Simple as that. That's my point here. All right. Excuse me. Okay. If landlords get wiped out, Wall Street wins, not renters. So, of course, the real issue here is that, you've got the mom and pop landlords. I've spoke about this before back a few weeks ago about, there's roughly 9 million, mom and pop or smaller type landlords out there, and they represent about 20 to 22 million properties. That's a lot, of properties, and a lot of these could have mortgages. So when tenants aren't paying, it's domino effect because the landlords maybe can't afford to carry that as well too, and everybody gets wiped out, and things lead to more problems. So that's definitely what's going to happen. And this is a report or an article from Bloomberg, and it really basically is saying very, very straightforward the fact that the next housing crisis is here. This time it's all about rentals, which I do agree with. That's the first market that's going to get hit. Across the U.S., landlords and tenants are wrangling over next month's rent, while an approaching avalanche of evictions threaten to bury them both. To avert the damaging wave of foreclosures like the one that swept the country more than a decade ago, Congress included provision in the $2.2 trillion rescue package it approved in March that allows homeowners with government-backed mortgages to defer payments up to a year. But Washington stopped short of offering renters comparable relief on the assumption that those in distress would likely qualify for the Treasury checks they began mailing out in April, as well as beefed up unemployment benefits. All right. Well, that was the source here, but also I know that not every person with a mortgage on their investment property can qualify for forbearance, etc. So realize that's that's going to be a problem here. So this chart basically shows that, when you take a look at ownership of properties, a lot of we'll call smaller investors, individual investors, trustees, tenants in common, whatever, are owning between 1 and 4 properties. All right. So obviously, as the amount of properties one owns increases, then we see, bigger real estate investment trusts, partnerships, LLCs, other bigger operations, etc. But the bulk of the 1 to 4, like having a couple properties here and there, are held really by individual people, and they're going to get hurt big time here. So about half of the 43 million rental units in the country are owned by small businesses, and unless help comes soon, both renters and property owners will slide down the socioeconomic scale together, and it will have a ripple effect. Rent doesn't just go into property owners; it pays for property taxes, mortgages, and salaries for people who maintain buildings, etc. So we really see this, again, as I said, a trickle-down effect here that will have a lot of problems for a lot of people. And this, to me, is the next crisis. So typically we find that, when there is a housing crisis, it's rental properties, second homes, vacation homes, like things that are extra additional, that aren't really primary home residences, that are the ones to kind of get hurt and fall. Then everything else kind of comes after the fact. So the next opportunity, if you're looking to purchase or wanting to invest, is going to be stepping in and taking over these things from people who can't maintain and handle them anymore, or can't handle the financial burden with these properties. That's what's going to happen. All right. So there you go. So that's what I tell you right now. This is happening in my market, and we have a lot of people who are looking for deals out there, and I'm helping them find them. So we'll talk about that in the future. But that's a great opportunity right now, is just to jump on these type of things that are changing the marketplace. Now, to go along with that, okay, we talked about Airbnb. So this is the CEO of Redfin was interviewed by MarketWatch here, and he basically said vacation real estate markets are toast because of the pandemic as Airbnb owners rush to offload their homes, Redfin CEO says. So just part of Redfin, just so we know, obviously they're real estate brokerage house. They also have an iBuying platform as well too. So they're based in Seattle. They said that Redfin, the Redfin Now segment, which provides instant offers to home sellers to purchase their properties, would resume home buying activities. In doing so, Redfin joins fellow iBuyers Opendoor and OfferPad in re-entering the housing market. Zillow said Thursday that it would also slowly relaunch its iBuying arm, Zillow Offers, in the upcoming weeks. So we're going to see a little bit of that. And the reason why they're opening, because we think it's a reasonably good time to own. House inventory is down 25% year over year, and home buying demand is almost back to pre-pandemic levels. So we're willing to take a risk again. I think we'll lower the amount we're willing to pay for a house just to give ourselves margin for error. So you see, so already they're going to vulture on this and say, hey, we're not going to be offering what we used to before. They're putting people on notice of that. And that's what we're going to find. So all these iBuyers, they're going to go in the marketplace and they're just going to lower their offers. Simple as that, because again, they're based on appreciation. They need to lower their offers. They have that spread when they either rehab it, hold it for a while, put a new buyer in the future, just like everybody does. So that's nothing. This is no shock here, but I do think it's interesting that, this is how they're going to adjust their business, which is a telling sign that we're going to see prices decreasing, because they wouldn't be offering higher prices if they thought prices were going to rise. They're stating we're going to be lowering our offer prices because they believe prices will be dropping in the future. He was asked, what's your take on the state of the secondary markets and vacation home markets right now? He basically said those are going to be in tough shape. There's a whole economy that was built around the liquidity that Airbnb provided. You get pretty deep into debt and still have somebody pay your mortgage every month because Airbnb, other travel websites, were so good at finding someone to rent it out. I don't think many of those folks have the financial reserves that a Marriott or a Hilton has these days. So that's a whole economy that was built upon around the liquidity there that Airbnb provided, and that's going to hurt big time. So the expectation is a lot of Airbnb hosts will be selling their homes, or going to need to offload them as quick as possible to keep cash flow positive and not lose money and get deeper in debt. Some have also suggested the coronavirus pandemic could lead to a migration out of major cities, especially like ones like New York City that were hit with the outbreak. What's your take on this? He said it's on like Donkey Kong. There's going to be a major move that was already underway just because of the affordability crisis. People are leaving New York for Philadelphia. People are leaving San Francisco for inland locations. So it was already happening. This now is just going to, I guess you could say, probably accelerate some of that and spur buyers to go out of the urban areas into the more suburban and rural markets just for these reasons alone. Okay, here we go. Now, interesting enough, we talk about values. New York City brokers expect real estate prices to fall up to 20%. This is actually a video. I'm not going to play the video for you, but ultimately what this boils down to is the fact that, in Manhattan and in New York, they basically believe that we're going to start seeing some pretty big discounts. And as I mentioned before, this is where, usually the Uber, the mega cities at the top of the markets will start seeing property values drop faster and discounts will be bigger. The commentary around this was based on the fact that there have been the sales for multi-million-dollar homes are slowing down. The discounts are getting bigger. The homes are on the market longer, and of course, people, they're looking to unload. They're going, you know what? Maybe I wanted to get $10 million for it now, but I can get $7.5 million for it. So there's a big decrease there. I'm still making money, or I'm breaking even, or I'm getting out without losing my shirt, etc. So you're going to see that. But again, their expectations, they believe real estate prices in New York City could fall up to 20%, which is interesting. And that's really about, besides the whole Zillow and other people saying 3 or 4%, which really is a very conservative and moderate estimate of property decreases, basically is saying we'll see some normalization, but don't be expecting any big discounts here, because they don't want to see big discounts. They can't afford the big discounts. They want properties to be maintained at a higher price point. It's better for them. But you got the brokers out here who are saying, hey, in some of these locations, we're going to start seeing some prices that are going to fall, and that's going to permeate its way down through the marketplace like it did last time. So keep your eyes on that. Okay, as states reopen, home buyers rush back out to look for homes, but sellers are staying on the sidelines, which is kind of funny here. So for the week ending May 2nd, total listings were down 19% annually, and new listings were down 39% according to Realtor.com. We had buyers ready, willing, and able, and the sellers have been the ones who have pulled back their homes, changed their minds, said a real estate agent that was quoted here. So this is what we're kind of finding now, is that, they're saying that buyers are rushing out to the marketplace. That I don't know as of yet, and I'm not too sure about how we can really verify that. Sellers, as they said, there's less listings being put on, less new ones, and listing inventory is shrinking as we speak. So, but here I think is the interesting part. The mortgage catch-22. Interest rates are lower than ever, but millions of borrowers can't get a loan. So here's what happens in a real estate crisis or potential crash or bubble bursting, whatever you want to call it, is that whenever something goes on, what does the industry do? It contracts. So it takes away buying, it takes away programs, it increases credit scores, income reserves, down payment, the whole bit. It makes it difficult for people to buy homes. So just when you need liquidity in the marketplace, it does the reverse. It actually tightens up and makes it difficult. So therefore, people are going, that's why I'm going to pull my house off. Why have it sit in market for days and days and days, and I'll be expected to cut my prices, take it off the market now, or not even list it, and we'll see what happens in the future. So, but that's the catch-22, is that it's the combination, right, of and their perspective is that we're getting great lower interest rates, but numerous lenders raised their lending standards, thereby limiting the types of borrowers they lend to, because they were trying to protect against lending to borrowers who were either about to or who had just lost their jobs. Which, listen, I get it. It really makes sense. Why would you want to lend to somebody who lost their job? It doesn't make sense. They can't pay. They've lost that ability. But it's just one of those things that they're doing that to protect themselves. But when they do a protection move like that, it also it doesn't help people who still have jobs, who aren't losing their jobs, that still need to find a house, that need to qualify for certain programs. So it does the opposite effect. This is just what happens when we have housing chaos that's going on right now. So, but talking to my mortgage contact the past couple of days, because I have some people who need to move and do some stuff, they are coming back a little bit. Okay, so that some of the people who had stopped doing mortgages are coming back. Maybe there's some program adjustments, maybe some increase some down payments or maybe some more verification, but slowly some of the people that were not lending before are slowly starting to come back into the marketplace. And we're talking some of the non-QM type things, stated income programs, things like that. Maybe you're not able to do, a 3.5% down, maybe a 10 or 12% down payment now. So things are going to change. It's going to slowly open back up again as time goes on. So that's a good thing for the buying side of the house. This is interesting now too. Senior citizens turning to reverse mortgages as a cash lifeline during the coronavirus crisis. So more seniors are turning to reverse mortgages as a cash lifeline during the pandemic. A reverse mortgage can be used in correlation with other retirement income strategies to lessen what's known as a sequence of return risk. Applications for reverse mortgages were up 15% in March, and you got to be 62 years old or older to qualify. Reverse mortgages are more expensive than other mortgages just because of the unique nature of their situation. So ultimately, you're going to see people going, okay, I need cash. We're having a major issue now. I'm going to turn to my home to pull the equity out in the reverse mortgage. So you're going to see more of that going on. And again, reverse mortgages can be defaulted as well too. There are people who are in foreclosure with reverse mortgages as well. So it just depends on how they take the money out and what they do with it and how long they keep it essentially. So, but again, that's something that's interesting that we need to keep an eye on as well too. Like anything, there people are saying they expect refis to go up, but again, the refi market will be hampered again by, we want refis or people want to refi, lenders want to lend, but with respect to, hey, we've raised standards, that's going to affect the refi market as well too, besides the purchase market, besides the reverse mortgage market here. So everything is affected by standards that are changing right now. Hopefully things will open up a bit more as the weeks go on. This is interesting. So if you go to Mish Talk, that's a site. His name's Mike, and he does a whole bunch of financial stuff here. He has these interesting charts, which I do like because he puts it into perspective quite nicely. So it's a bad time to buy a home. Well, is it a bad time to buy a home? Why is that? Well, this is the chart I've used before, and why it's a bad time to buy a home, because everything is out of convergence. So really, the great times on this chart to buy a home were just before the Great Depression or Great Recession, before the last housing crisis, the 2000 sort of, 2, 3, 4 times, right, the early 2000 decade. You've got the fact that you have consumer price index, you have rent, you have wages, case-shiller price growth, all were, moving along at the same price point. You can see how the line that had the big bump, that's the Case-Shiller U.S. Home Price Index, and that grew big time, whereas rental rates and wages sort of plodded along at linear pace. We had the peak, and then it crashed, and of course around 2012, you can see that secondary square there is where they converged again, where wages were in line with rent, which is in line with consumer price index, which was in line with housing prices. So that was your best time to buy a home. And as we go forward, well, guess what? We see the home price index has certainly increased big time. That's the top line. Rent is the line that's red, and that's increased as well too, more linearly. Wages has increased, but not as much, and there's still a gap. So there's always a gap between rent and the gap between home price index. So basically, what he's saying is that now's not a good time to buy a home. There are people who need to buy a home, and I realize that, but his point is the National Association of Realtors would not like this post, but home prices need to come down, and they will. Even before the COVID-19 pandemic, home prices were on a trend that was unlikely to continue for long. I agree with that. Median home price versus median household income, another measure that tells the same thing. The home price and household income are out of whack as well too. Both charts show very stretched valuations. Home prices have outstripped hourly earnings, household income, and rent. And he feels that there's a massive back in May 3rd. I didn't put that up here, but there was a chart and a survey done on May 3rd that basically showed that there's a massive drop in home buyer interest right now. And that's obviously because of the loss of jobs, the financial economic times we're in, the uncertainty going forward. So unfortunately, the unemployment unemployment and job losses are understated, and that's going to manifest itself with respect to what's going on in the housing market here. So he's saying not a good time to buy a home now. What that means is I wait to see declines. That's his perspective right now. Just one person giving their 2 cents worth with respect to what's going on in the industry. He talks a lot about the financial markets and everything, so I do tend to think he's somewhat of a reliable source as to what's going to happen in the future. All right, that's the scoop for now. Lots of other articles I didn't jump on today. I just want to give you some of the highlights here. And really, the issue is that mortgage credit availability. We talked about that. So if you're going to buy a house, you may have a hard time buying a house, which actually may be good because maybe that hard time will bring less buyers to the market, which means more homes eventually will come on board and prices will reduce, etc. And by that time, we've got more foreclosures hitting the marketplace and more distressed property out there as well, too. So the impact has been dramatic, with one model showing mortgage credit availability has plunged more than 25% since the outbreak of the virus. So when you have a certain segment of the marketplace who were getting, I guess you could say, low down payment mortgages, we could call them Fannie, FHA-backed mortgages, etc., standard incomes, tougher mortgages to get. We see a lot more riskier mortgages that were being offered, and as properties were still peaking or still at some pretty significant highs with respect to their values, we're seeing about 25% of the mortgage availability gone now. This is going to normalize the marketplace. So in March, riskier borrowers could get a mortgage but just pay a higher price to other people. Now some people are just not going to get mortgages. It's simple as that. That's what we're going to see here. So the Mortgage Banker Association releases Mortgage Credit Availability Index for the month of April, and it records a 12% decline over the previous 31-day period. The lower the index gets, the harder it is to qualify for a mortgage home loan. And this index hasn't sunk to these depths since December 2014, when the nation was still recovering from the 2008 housing crash. So there you go. So it's tough out there, and it's very difficult for some buyers to get mortgages, which is going to keep them on the sidelines. So that's one of those things where this is where we still get conflicting information in the marketplace. So it's almost like some articles are saying buyers are coming out, but then we're not seeing the sellers. The sellers aren't listing their homes. If this article said buyers are coming out, but now we're seeing, mortgage credit availability is getting chopped here. So where are these buyers? So this is again this unique time in housing and the real estate marketplace where it's tough to believe certain pieces of information just because we're getting different perspectives, different points of view, whether it's being spun for their industry or for the sake of the article, who knows. I just know that we're going to see a lot of carnage out there. We're going to see the first of all the Airbnbs and the ma and pa, average, small investors losing their homes or going into foreclosure situations because of the domino effect of non-payments and job loss and whatever. And then that's going to manifest itself into homeowners who are going to get shocked and won't be able to run through loan mods and their forbearance issues and things like that. We've only been really a full month into the non-payment cycle of the month of April. This week we'll report on the previous week, which is the first full week of May, and we'll see how the forbearance numbers hit there as well too. But I expect we're still going to see some numbers grow in that area, and that's going to obviously cause problems as time goes on. So that's scoop for today. So by the way, just what I got going on these days, obviously, as I mentioned, buying and selling property, we can help you with that. A lot of off-market investing, I can do that with people as well too. We're looking at a lot of properties right now. I spent the morning analyzing about 40 properties that we're trying to get our hands on for our clients, potential buyers, whatever. So if you want information on that in this area, give me a shout. I've got my short sale cash connection, which is really short sale advanced training product, which you may want to get involved with because there'll be a lot more short sales coming these days. Never pay retail. That's kind of our entry level sort of general real estate investing, home ownership, etc. I'm beefing that up as well too. So we got lots on the go. So please inquire if you want some help. So once again, guys, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not already a subscriber, please subscribe. Help my channel grow. I appreciate it very much. And we look forward to speaking with you in a couple of days. All right. So take care and good luck out there. Let me know if I can help you. All right. Thanks.